You're tuning in to Financial Fitness Northwest, live on 1150 KKNW. We're here to help you navigate the mortgage and real estate market with expert advice from knowledgeable and trustworthy industry professionals. We're dedicated to provide the tools you need to make informed decisions on how today's events in our local economy can affect your buying power. So today, Patricia and I are going to cover an overview of our current market rates, where rates are going, values, and why now is a time to buy.
Yes, we are.
Time to buy.
It is. It's a really good time to buy. So we're going to give you hopefully some good information.
Some insight. So, crystal ball, right? We don't have it.
We do not have it. Yeah, we cannot. We cannot exactly predict. And apparently, a lot of the professionals that actually do this sort of thing can't predict either, because they've been saying that rates are going up. Rates are going up, but
they're not.
What's happened?
They haven't.
They have not gone up.
No,
they are still great. It is such a great thing.
Yeah, rates are still really low. I mean, the Fed's been saying that rates are going to be going up since like 2013. We were at about 4.5%, and today we're still at 4.125.
Now we're 4 1/8. We're actually not even as high as we were at previous points. So,
right. So I mean, they are predicting, that rates will go up, but I don't, maybe by the end of the fourth quarter a little bit, but really you're looking much further out than that.
Probably more like the end of 2018 is what is more realistic.
What they're predicting, the Fed's predicting. So aren't you lucky that you don't have to buy at your parents' rates?
I know.
So we just took a peek at the, historical rates, over the time periods, and it's kind of, it really puts in perspective how fabulous rates currently are. So
it really does. I mean, you hear that a lot, and you probably just kind of in one ear and out the other, but it's crazy. I mean, in the 70s, the rates were close to 9%.
Yeah, that was the average. So,
average, yeah.
In the 80s, you're at like, 12.5 average. They were up to like 16, 17%.
There were points, where it got really high. In the 1990s, the average rate was a little over 8%.
Yep, and then in the 2000s, just 6.25. So that was the average rate in the 2000s, 6.25. Here we are today,
still in the fours, low fours.
So it's great. I mean, I think that there was like a little minute of time where rates were, in the threes, and everyone expects that rate. That was just, a crazy little dip. But being right at 4% is a fantastic interest rate.
It really is.
Yep.
I mean, obviously, I don't, I don't think anybody's predicting that rates are going back up to 12%.
No.
But, and the reality is even when they go to 5%, historically, that is still a really good rate. So,
right.
I think it's the timing is really good right now.
It is. And, so people kind of associate values with rates, which you shouldn't, because interest rates don't really have an impact on values. So even over that time periods where the rates were in the 12-8% range, the average increase year over year from the 70s to current was still 6% of values.
Yeah.
Because sometimes they're much higher, but and there were periods where, maybe the annual increase was only 2%. But as an average, 6%. Mm-hmm. No matter what the rate is, your value, you're still going to gain equity.
Right.
Values are still going to go up.
Yeah. So there's some, you might be feeling like, values have continued to go up. If rates go up, what's going to happen? Is my value going to plummet? But,
no.
Numbers don't lie. So when you look at the historical facts of what has happened, even when rates have been high, values have continued to appreciate.
Right.
So,
but 75% of people surveyed believe that appreciation will significantly slow their home value when rates increase to 5%. And so we just want you to know that's really not the case. And then, where are rates going?
Yeah. So
that's the big question.
MBA, forecasts projections of rates that they'll be up around 5% by the fourth quarter of 2018. So we still have a long window.
Yeah.
I
mean, that means between now and next year, we're still in the fours. Mm-hmm. And that's even if we get there, because they've been predicting the rates were going to go up this year to 5% by the end of the quarter, and we're nowhere near that.
No, we're not. Not to say that should be a reason if you're considering purchasing and you've maybe been feeling pressure about the looming increasing rates. That doesn't mean that the fact that they're not really going up is not a reason to wait, because values are still continuing to go up. So the more the value goes up, that's, decreases your buying power.
Right. And we're going to talk in more depth about that in a little bit,
yes,
too.
Yes, we are.
So, right now, we've covered this before, but I think it's important to cover it again, is that why we're not in a bubble, because I think that's another reason people are hesitant to buy, is they think we're in this bubble, but that's not at all the case. There's a lack of inventory, so the demand is not going to catch up with the inventory.
And just to note, these are things that, these reasons are things that we did not have when we did have the last bit of a crash that we had. It was a completely different situation. Values had gone up, but there was a lot of other factors that came into play that are not factors currently. And another one of those is just the whole lending and underwriting standards. In the previous, 2006 situation, we did not have anything close to the lending standards that we have today, and the ability to repay requirements and so forth. So with solid responsible lending in place, that is a huge thing. That's a lot different now than it was before.
And also the buyer pool has, increased as far as well-qualified buyers. So, there was a period of time a few years ago where there wasn't as many qualified buyers because a lot of people had derogatory things on their credit. And also lending guidelines got very strict for a period of time. But that has since, somewhat loose, and you still have to, be able to prove that you can repay the loan. But there's not as many overlays, making it harder to qualify. And those buyers that had those negative, derogatory things on their credit, as like a foreclosure or bankruptcy, have since passed their waiting period and are qualified again to purchase.
Right. Well, and this also speaks to the fact that the programs that we used to have, the Ninane, if you've heard that kind of term, no income, no assets, no employment required to get a loan. I mean, that just doesn't happen anymore. So buyers that are in the market today can qualify for a loan proving their income. So it's a different situation.
Right. And then homes are still affordable. So, obviously values are increasing, but homes are still affordable because rates are low, which increases your affordability, and, prices aren't out of reach. And so the longer you wait, the further out of reach they will get, affecting what you will be able to qualify for.
You might have to commute a little bit further than you want to, but
which just put your money in your gas rather than your home, I guess.
Yeah. There's definitely still a lot of homes out there that are below the average, which we'll talk about that too.
Yeah, so there's like 4,000 people that migrate to the Greater Seattle every month.
Every month.
Crazy?
Is that not crazy? I mean, it's kind of not. I mean, when you think about it, how big the city is and how much industry we have here and how many amazing companies with Microsoft and Boeing and just a lot of new companies too.
It is, but it is a little astounding to me to think that 1,000 people move here to live every week.
I know.
So that just goes back to, how the demand is, the inventory is never going to be able to keep up with the demand. Therefore, we're not in a bubble. Before, there was just so many houses. You could go, house shopping and you look at 20 houses.
Yeah, I want to pick my favorite out of the next, 50 houses that I look at. Now you're lucky. Maybe there's 5 you can look at.
Or 2.
Or 2.
In a month.
Or 1. I like that one. I'll take it.
Yeah. Oh, I've got to pay $50,000 over ask. No problem.
Yeah, I know.
Yeah, so it's a different world.
So different.
This is really just jobs are driving our economy here. Seattle. What was this? We just heard that Seattle has the most cranes in the U.S. We're like rapidly growing. There's so many cranes in Seattle and Bellevue.
Yeah, it's crazy. So those are not. I mean, obviously
facts.
They're positive on both sides because a lot of those cranes are building new office buildings, which is more industry and more jobs, and they're also building a lot of apartment and condominium projects. So just a lot more going on here than other cities.
Right. And so let's talk about affordability, and homes are still affordable. This is going to not sound super affordable, but the median home price in King County right now is just over $600,000.
Yeah.
That includes the Seattle area. It does go down. I think, the Seattle area is higher. It drives up the median home price.
Well, it does. And the thing the thing I don't kind of like about that statistic is that, there's, a $12 million property on Lake Washington for sale. That's in the, if it's on the MLS, that's in there too.
Right.
So the numbers can be skewed. Now, if you do want to buy a house in the Bellevue, Kirkland area, it's definitely pricey, but that's not to say that you can't still get a nice home for, $300,000 down south. I mean, there are homes, depending on where you live. I mean, you might be in Tacoma, you might be in Puyallup. There's,
right. But those are not King County.
No.
That'd be Pierce County.
No, that would be Pierce County. But just to say that the numbers, they're skewed to the high with some here, really expensive properties.
Right. There's a lot of money in Seattle. So, but what we really want to touch on too is like what would happen. So let's say we're using, the median home price is $600,000, but let's say you're buying $400,000 or $500,000. What would happen if rates went up 1% and how that would truly affect your buying power? If you qualified for a loan of $400,000, a purchase price, you're buying a home for $400,000, and rates went from 4.25% to 5.25%. What does that mean to you? Now you only qualify for a purchase price of $356,000. You just lost, $44,000 in purchase price.
Yeah,
that's a lot.
It is a lot,
and it only goes up from there.
It goes up from there. So, if you were in the $500,000 range, rates go up. You can only buy $445,000.
Right.
So it really diminishes your buying power with the increase in rates.
It does. And where I think it also really hurts people, is going to affect people a lot too, is in the like $600 to $750 price range, because it has a greater effect on your buying power, and you're in the east side, so it could actually price you out of the area you want to live in.
Yeah.
Right. So like if you're qualified for $600,000 and that's kind of like bare minimum east side, and then rates go up 1%, you now can only buy $534,000, which is going to push you out of the area.
Yeah, you're not going to find it. You might be going from a single family to a condo or something.
Oh, yeah, for sure.
Yeah.
You would be.
Yeah. And then it's even worse. At $750,000, with 1% increase, you're going to drop to $668,000. Yeah. So, the higher the loan amount, the higher the purchase price, the more effect that increase in rate is going to have on your buying power.
Yeah. And last, I'll just share, like, if you're in the $1 million price range, then, you qualified for $1 million, you now only qualify for $890,000. That's a big difference.
Big.
Yeah. So we're just going to touch on rent versus own and why it makes sense all day long to buy a house versus rent a house. So we're going to use an example. If you're buying $600,000, we're just using the median home price. Your monthly rent is going to be less.
Yeah, you're going to pay less. You don't have taxes and insurance.
Right.
Well, you have insurance, but
not the same.
Not the same. You don't have taxes. You don't. It's out of pocket expense seems less when you're renting.
Right.
But really, it's not.
It's not. So we're going to break it down for you. So first off, we'll just talk, like, if you're paying your mortgage and your rent's going to be about $900 less a month, but rents are increasing. So if you use the historic average of how rents are increasing, by year 9, your rent is actually going to be greater than your mortgage. So you're only saving monthly on rent for those first 8 years. 8, you level out. Year 9, it's more expensive. But where it really kicks in is what money you're leaving on the table.
I know. These are the numbers that I love these numbers because it's just so crazy. So in 9 years, you would have paid about $44,000 less in rent than you would if you had a mortgage payment on a $600,000 property. Okay, well, that sounds good, except for here, listen closely. When you calculate the appreciation of that property that you own, so that's equity through amortization, which is basically the principal and interest that you're paying down every month, you are losing, and then appreciation, you're going to lose over that period $309,000.
Right.
$309,000. That's crazy.
Like, that puts you in a whole different financial position in 9 years.
Yeah.
By making the choice to buy versus rent. So, like, let's say we're going to show you how this works out. So assume that your home appreciates 3%, which is actually extremely low right now and even historically low. So 3% is really conservative. On a $600,000 home in 9 years, it would be worth $782,000 plus some more money. And then after 9 years, that's going to give you $183,000 in appreciation. $183,000 right there, just in owning the home and it going up with values rising.
Just paying to have a roof over your head, which you're doing if you're renting too. Only you're going to have $183,000 more money to yourself,
right?
by owning your home, and then just by making your mortgage payment, you're going to build another $106,500 in equity.
Right, just by making your payment because you're paying your loan down.
Yeah.
So just by making your principal payment, you're building that amount in principal, and then. Taxes. You know, renters just forget about, you know, they hear, oh, you get tax benefit, but it's substantial. In 9 years, let's just say you're in the 25% tax bracket. Okay. You are going to have a benefit of $63,700 over 9 years in tax write-offs. So you literally, if you add that all up, that's $353,000 in 9 years, minus that little old $44,000 that you're leaving on the table that you had paid less in rent, and you're walking away from $309,000 by not buying.
Crazy.
Well, who would do that?
Who would do that?
There's so many options to buy.
There are, and we can help you with those.
Yeah,
we totally can help you. We want you to have that $300,000 in your pocket.
It is literally one of the most substantial ways that you can build wealth for your family. And so it is important because, you know, you want to set yourself up for success and your family and a legacy. And this is how you get started.
It is.
By owning a home.
It is, you know, and a lot of people think they don't want to be tied down by a home. But I mean, how can you deny those numbers? You know, you're paying rent. You know, I would say that the chances are very, very slim that you're going to save $309,000 in 9 years if you're paying rent, because you still, you know.
You can't save at that rate.
You can't save at the rate that you're going to enjoy. And just to reiterate, we only used a 3% appreciation. And right now, like, what is the average home appreciation in our area? Like 10 or something?
Yeah.
So, like, I mean, 10%. It's really the number. If you want to use absolute current numbers, it's substantially more than that. But we've gone the very conservative route.
We have. And so it just really makes sense. And we want to help you guys be in a position to build wealth. And this is the first step. And so let's say you're ready. You think, gosh, you know what? I'm going to jump into the market because Sarah and Patricia really think it's in my best interest.
Yeah.
Yeah. And this sounds great. So let's see what my options are. But, you know, I heard this is a kind of a tricky market because it is.
It is.
And it's a little bit scary. But there are ways that you can set yourself up to win. The deal. So we're going to just talk about some sort of ways that you can submit an offer that's going to put you in the best light, best foot forward to help you win the deal. Kind of like a little checklist. So some things you can do. One is by getting fully pre-approved, obviously.
Absolutely.
And even taking it the next step and having your lender or us underwrite your loan for you. So you're fully underwritten. Because really, the biggest thing is that the sellers want to know is that you have the ability to close.
Yeah, they do. And that is one thing that we do. We're not talking about the, you know, just the pre-qual letter. I mean, when we have a client come in and do their application with us, we're going to get them fully approved through underwriting. So you're going to have a really solid offer when you go out into the market and find that home.
Right, because one of the biggest reasons or biggest things that you want to do in your offer that helps you be competitive is by reducing your closing period. Being able to close quickly and having your loan done, basically, up front, gives you the ability to make a really tight closing time frame.
Absolutely.
20 days or less is almost as good as cash.
Yeah, it is. And it's going to really set you apart because there's not a lot of lenders out there that are going to be able to guarantee the kind of closing timeline that we are able to do.
At Caliber Home Loans.
Yes.
So, and then also by getting your loan fully underwritten and approved, it gives you the ability to reduce your contingencies for like loan approval. You know, a lot of times that's like 15, 20 days, but you could have it be 7 days because your loans are already approved. You literally could waive that contingency. You could waive financing altogether because your loan's already been approved.
Yeah, makes a big difference.
It's huge. Other contingencies that are important to remove but don't necessarily have to is like the appraisal.
Yeah.
What does that mean if you have an appraisal contingency?
I don't necessarily recommend doing that, but
it makes for a strong offer, but you have to have the cash to back it up.
You do, because if you have basically that's saying that if you have a low appraisal, you're just going to make up the difference. And in this market, even though everything is going up, there's pockets, and it gets a little sometimes challenging with the appraisal because there's not a lot of comps, because there's not a lot of inventory. So if you happen to be looking at a house in an area where nothing is sold, it's just a little bit more risky. But it depends on your financial situation and what you want to do.
It does. And I think it really also depends on your agent and your lender team, because your agent's really going to advise you. And if they have a good pulse on the market, they're going to say, okay, we're offering this, but based on comps, this house isn't going to appraise for, X amount only. So you're going to be, you could be 10,000 short if you waive your appraisal. But that's when you go back to your lender and you say, okay, what if this happens? What are my options? Because doesn't necessarily mean you have to bring more cash to the table. You can just restructure your financing. And we've done that a lot for people.
Yeah.
Just reduce your down payment. Still, not including MI, still no MI. There's a lot of things you can do, but you have to work with some experienced people who are all hands on deck. They're all working together.
Yeah. It's a team. It takes a team effort.
So the other things, people are doing is, writing letters of the heart.
Yeah, that actually can be a really, really positive thing. If you put a personal letter together that your agent presents to the seller, people are emotional. So they might just be, happy to have a little family and a, golden retriever and whatever in their living in their house. So they might love
pictures and they do like that. You have to, your listing agent the listing agent, you really want to find out what from them the sellers is driving the sellers.
Exactly.
Right?
People, maybe, some agents might not ask that question, but it's really important. What is the seller? What's going to appeal to them? What's going to be their hot button?
Right. Is it time? Is it a closing timeline? Do they need more time so they can find a house? Do they, are they driven by money? We all are, but to some degree, they might not want an investor. If you're up against someone paying cash, but it's just they're buying as an investment property, and you wrote this letter,
how you're going to you're going to love their house and, raise your kids there.
Right.
And they might just be like, oh, that's what we want, a nice family in here.
Yeah, exactly.
Yeah.
So you have to find out what motivates them and then just really appeal to that. That's huge. And that really plays into having a really experienced agent on your side, advocating for you.
Totally does.
Right. What about other things we've done? Like writing a letter or having your lender call. I've done both, where I've written a letter on the behalf of the buyer, our clients, and then also we always call the listing agent.
We do call, and even in a depending on the situation, but we could even go to the presentation of the offer to the listing agent, be right there representing our buyer and saying, these guys are good to go. There's so much power in that.
Oh, my gosh. Do you know how many listing agents complain that they never hear from the lender? They don't know what's going on. So having a lender that before the transaction is even, in play or has even been accepted, you're like, here I am. Here's how we're going to communicate with you. Here's how qualified my client is. It is like hands down, like the most powerful thing.
It's a game changer.
Yeah.
You are going to win that deal.
Right. And I think if you work with a lender at a bank, they don't make those kind of appointments.
I'm pretty sure, because it might be a night or a weekend, and they don't work then.
No, they're not working. So, those just, again, play into having a really good team. But I think hearing from the lender. And something else we've come across that, don't be afraid if you don't have 20% down. That doesn't make your offer less competitive.
It doesn't. It doesn't. That's just one factor. It does not mean that you're not going to get the deal.
No. And, we've had times and we've called, and said this to the listing agent where a client doesn't have 20% down, but it's because financially and strategically, it doesn't make sense for them to take money out of investments when they can borrow at 4%.
Right.
So they're putting less money down. There's so many options now with jumbo no MI and all these things that you don't have to put 20% down, and it doesn't have to make your offer look less competitive if you have the right lending team backing you up too.
Absolutely.
So that's just one thing to consider, because I feel like people get deterred by that. But,
yeah.
And then, I guess The other things would be, just making sure your offer is really clean and, you have a really good selling agent that puts together a really nice contract, right? Because we have a couple people that we work with that are like super detail oriented. And when I talk to the listing agent, they say, oh my gosh, I have never seen like such a like complete contract.
Yeah. Or they say, I love working with them. They're so on top of it. And so it is, your agent can carry a lot of weight as far as your deal getting accepted too if they know what they're doing. So if you need an agent referral, you can always call the Riley Johnson team and we can help you find a good real estate agent.
Yeah, give you the winning team.
Absolutely.
So, there are, in this market, if you do have to sell a house, a contingent offer really isn't as powerful.
No, but there's ways, right?
Yeah, there is. I think you have to, we've talked a little bit about before, but doing a rent back.
Yeah.
You can sell your house to someone and then run it back for them and give you 60 days to go find your next house so that you have your cash in hand because your house is sold. You're renting your house back, and then you have time to go find your new home, and it's non-contingent.
Yeah, and there are people out there, especially if, the good thing about that 4,000 people a month coming here, they're probably in temporary housing, or maybe they've rented an apartment for a while to get a feel for the area. So they have the flexibility to wait a couple months to get into your house, and with inventory low, the buyers loving your house, they're willing to wait.
Oh, yeah. They are. I mean, there is a lot of temporary apartments right now. I have so many people that, pay first last for like 3 months or 6 months because they're, they're looking to buy. So,
yep.
Well, you guys, I hope you found that information valuable. Thank you so much for tuning into Financial Fitness Northwest. We are wrapping up for today's show, but you can find out information about this episode on our website and on our Facebook page. Please follow us. We look forward to talking to you guys next week.
See you next week.